Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 3. This is Section F. This is an analysis topic. Determine the effect of uncorrected misstatements on an entity's financial statements in an engagement. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it is free, it is only 1 hour long, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years failing the exam. So make sure you check out the webinar, and after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to the full 10-question versions of these videos. So in today's video, you're only going to be getting 5 questions, but again, SuperfastCPA Pro members will get access to the full 10 questions versions of the videos so that they can get a little bit more help and a little bit more understanding. Now with that, let's dive straight into the questions. Okay, here we are at question 1. Let's just dive straight in. Which of the following best describes how an auditor evaluates the materiality of an uncorrected misstatement identified during an audit? So let's go through the options. Option A, the auditor only considers the size of the misstatement relative to total assets or net income. Option B, the auditor evaluates both the amount of the misstatements and whether it could influence the decisions of users of the financial statements. Option C, the auditor evaluates the frequency of similar misstatements in prior audits but disregards the current year's context. Or option D, the auditor defers entirely to management's assessment of materiality provided it is documented in writing. All right, so what is the best description of what the auditor is going to do to evaluate the materiality that's identified during an audit from uncorrected misstatements? Pause the video if you want, but if not, that's okay. We're using these questions to learn. So if you don't really know what this means, that's okay. We're going to look at the answer together to start learning. Okay, here we are at the answer. B, the auditor evaluates both the amount of the misstatement and whether it could influence the decisions of users of the financial statements. So let's go through the explanation. When evaluating the materiality of an uncorrected misstatement, the auditor considers both quantitative factors, such as the dollar amount of the misstatement in relation to key financial benchmarks, and qualitative factors, such as whether the misstatement affects compliance with regulations, masks a change in earnings trends, or impacts management compensation. A misstatement that appears small in size might still be material if it could influence the economic decisions of financial statement users. All right, so we learned a little bit about how the auditor is going to evaluate the materiality of an uncorrected misstatement in this question. Now let's go to the next one. All right, here we are at question 2. When evaluating the materiality of an uncorrected misstatement, which of the following should the auditor consider? So let's go through the options. This is a little bit similar to the first question. Option A, only the dollar amount of the misstatement in the current period. Option B, whether management intends to correct the misstatement in the next period. Option C, the size and nature of the misstatement, the surrounding circumstances, and its effect in relation to misstatements identified in prior periods. Or option D, whether the misstatement was discovered through substantive procedures or tests of controls. Okay, so what is the auditor going to do when they're evaluating the materiality of uncorrected misstatements? What are they going to consider? Now, based on the first question, you might kind of be able to figure out your way around this or kind of think through this. But if not, again, that's okay. We are using these questions to learn, so let's dive into the explanation. Okay, here we are. The answer is C, the size and nature of the misstatement, the surrounding circumstances, and its effect in relation to misstatements identified in prior periods. So those are some of the things that the auditor is going to consider. Auditors must consider more than just the dollar value of an uncorrected misstatement. They evaluate the size, and that's a quantitative factor, and the nature, which is a qualitative factor of the misstatement, the circumstances under which it occurred, and whether similar misstatements have accumulated over time, which could make a pattern of immaterial misstatements collectively material. This comprehensive analysis helps determine whether the financial statements are materially misstated as a whole. So the auditor is going to have quantitative and qualitative factors that they're going to consider. They're not only going to consider the size, but they're also going to consider the circumstances surrounding it, whether it's something that's accumulated over time, things like that. So the auditor needs to consider all of these things when they see an uncorrected misstatement so that they can kind of evaluate the materiality. Now let's go to the next question. All right, here we are at question 3. Which of the following best describes how uncorrected misstatements from prior periods affect the auditor's evaluation in the current year? Let's go through the options. Option A, they are included in the auditor's cumulative evaluation to determine whether the current year's financial statements are materially misstated. B, they must be disclosed in the financial statements regardless of materiality. Option C, they are excluded from the current year's evaluation because they relate to a different reporting period. Option D, they are only relevant if the client intends to restate the prior period financial statements. Okay, so how are the uncorrected misstatements from prior periods going to affect the evaluation of the auditor in the current year? Think about this, pause the video if you need to, and when you're ready, come back, we'll look at the answer together. Okay, here we are at the answer. A, they are included in the auditor's cumulative evaluation to determine whether the current year's financial statements are materially misstated. So let's go through this. Uncorrected misstatements from prior periods are not ignored. They are carried forward and included in the aggregate evaluation of misstatements in the current year. the auditor must consider the cumulative effect of these misstatements, especially if they have persisted or compounded. This helps ensure the auditor doesn't overlook misstatements that may be material in total, even if they were deemed immaterial in isolation in prior years. So auditors do need to take into account uncorrected misstatements from previous periods because, if they are things that keep happening, they could be something that actually is material cumulatively, even though separately it wasn't material. Now let's go to the next question. Okay, here we are at question 4. Which of the following uncorrected misstatements would most likely be considered material due to its nature, even if it is small in amount? Let's go through the options. Option A, a $15,000 error in payroll expenses due to a rounding issue in a spreadsheet. Option B, a $20,000 misclassification of short-term debt as long-term debt, which causes the company to appear in compliance with a loan covenant. Option C, a $10,000 overstatement of supplies inventory in a company with over $10 million in current assets. Or option D, a $25,000 duplicate entry in office expense that is reversed early in the following year. So out of these options, which one is going to be most likely considered material even though it's not that big for the company? Now, based on what we've talked about so far, you probably could figure out what the correct answer is, so pause the video if you want to and if you need to, and when you're ready, come back, we'll look at the answer together. Okay, here we are at the answer. B, a $20,000 misclassification of short-term debt as long-term debt, which causes the company to appear in compliance with a loan covenant, so that's definitely fishy. Even though the dollar amount is small, $20,000 isn't that big if you're a big company, the impact of the misstatement is significant. Misclassifying short-term debt as long-term may cause financial statement users, such as lenders, to believe the company is in compliance with its loan agreement when it is not. This could influence decisions made by users, making the misstatement material by nature, despite being under the calculated materiality threshold. Because remember, the idea behind materiality is it something that would affect the users of financial statements if they knew about it? And this would definitely affect them if they knew about it, because if a company is actually not following their loan covenant, but they say they are and the user thinks they are, that's definitely deceiving the user, and that would be a material problem, even though it's not that big of a number. $20,000, again, if you're $1 million company, isn't that huge. Now with that, let's go to the next question. Okay, here we are at question 5. An auditor identifies a deviation from a key control during testing. What is the auditor's most appropriate next step in response to the deviation? Let's go through the options. Option A, immediately increase overall materiality to offset the control failure. Option B, conclude that the deviation is not relevant if no fraud was involved. Option C, assume the control is ineffective and discontinue any further audit procedures. Or option D, inquire of management to understand the cause and potential consequences of the deviation. So what is the auditor going to do in this case? Probably pretty easy to think through this because, again, in a lot of situations in audit, if you read carefully through the options, 1 or 2 of them are going to be obviously wrong. So you can usually narrow it down to 2 or maybe even the 1 correct answer if you just think through it. So pause the video if you need to and come back when you're ready. All right, here we are at the answer. D, inquire of management to understand the cause and potential consequences of the deviation. Again, if you thought through those different options, that one made the most sense. Let's go through the explanation. When an auditor finds a deviation from a control, they are expected to inquire of management and others within the entity to understand why the control failed and what potential impact it may have had on the financial statements. This helps the auditor assess the severity of the deviation, whether it is isolated or systemic, and whether the deviation could result in a risk of material misstatement. Jumping to conclusions without further inquiry is not appropriate, and we've talked about that across multiple videos. Now with that, we've learned a lot in this video just through these first 5 questions. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the factors that an auditor needs to consider if they find uncorrected misstatements, and the factors that they need to consider to be able to figure out if it's material. Those are the kinds of things that you're seeing pop up in the questions. So you take a moment and you write these out in your own words as the pillar topics, the key points of what you learned. And as you do this each day, you build your own personal repository of the most important things you learned from the questions in your own words so that you are prepared for test day. Now let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, let's talk about materiality of uncorrected misstatements. That was kind of the big ticket item for this video. Auditors evaluate uncorrected misstatements based on both their size, that was quantitative factors, and their nature and context, that's the qualitative factors. Even small misstatements can be material if they affect decisions of financial statement users. Now let's talk about cumulative and prior period effects. Auditors must consider the combined effect of all uncorrected misstatements, including those from prior periods, when evaluating whether the financial statements are materially misstated. And that makes sense because you want to see if they have a cumulative effect, even if they were immaterial at the time. And then let's talk about qualitative materiality examples. Misstatements that affect loan covenant compliance, related party disclosures, or earnings benchmarks may be material even if they fall below the overall materiality threshold due to their potential influence on users. And we kind of just barely talked about that in the first pillar topic as well. And then let's talk about the final one, auditor response to control deviations. When a control deviation is found, the auditor should inquire of management to understand the cause and potential consequences rather than assuming the issue is immaterial or isolated. So they find this uncorrected issue with this control and, they're not going to just assume that it's immaterial or that it's isolated or that there's no issue. They're going to go ask management, hey, we found this uncorrected problem. What would happen if this wasn't corrected? And with that, we've gone over the pillar topics for this video and the first 5 questions. Now remember, in this YouTube version of the video, we're only going to be going over 5 questions, but SuperfastCPA Pro members are going to get access to the full 10-question version of the video when we post it in the member forum. So if you like this and you like our other videos, check out becoming a pro member to get access to the full videos. Now, the easiest way to become a pro member and to learn about it is actually by first going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam. And again, that will give you the best path to learning about and becoming a SuperfastCPA Pro member. So check that out. Now, if you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.